Getting paid in physical cash is not automatically illegal in Australia. An employer can legally pay your wages in notes and coins. The problem arises when an employer pays cash specifically to keep the arrangement off the books. When that happens, the worker still remains fully liable for declaring that money as income. The Australian Taxation Office provides explicit guidance on this. The physical medium of payment does not dictate its taxability. The absence of an electronic banking trail does not turn wages into non-taxable money. The phrase cash in hand is commonly used to describe an arrangement where an employer hands over physical cash and deliberately fails to withhold tax or report the transaction. Fair Work describes this type of evasion as unlawful. The moment a worker performs a shift, a mandatory statutory framework surrounds that transaction. An employer handing over a plain physical envelope does not erase the legal requirements for PAYG withholding, superannuation contributions, and a statutory payslip. The obligations of the employer and the employee are distinctly separate under Australian law. If an employer fails to meet their payroll reporting requirements, the employee still holds a legal obligation to declare their true assessable income to the ATO. Ignoring cash income on a tax return simply because an employer decided to hide it transfers the legal risk of tax evasion directly from the business onto the worker. Employers attempting to evade the system frequently rely on a specific lie to keep workers quiet. They tell employees that no payslip means no tax. This is false. Fair Work mandates that employees must receive a payslip within 1 working day of payday. This legal requirement applies identically to electronic transfers and to wages paid in physical cash. This layout compares a proper statutory payslip against a handwritten cash receipt. A legal payslip details the employer's ABN, the gross pay, the exact hours worked at a specific hourly rate, the net pay, and superannuation information. A handwritten receipt merely states a dollar figure was handed over. Fair Work does recommend that cash-paid workers and employers sign a record confirming the payment. However, a signed receipt only proves that a specific amount of money changed hands. It does not prove the hourly rate was legal, nor does it confirm that tax and super were handled correctly. Providing a cash envelope without a formal payslip is a glaring red flag for stolen wages and tax evasion. An employer withholding proper documentation is protecting their own liabilities, not doing the worker a favor. To understand exactly how a worker gets shortchanged, we need to look at the mathematical core of all employment, gross pay. This flowchart shows the required path of Australian wages. Every calculation starts at gross pay. From that total, the money diverges. One portion travels down to become net pay, the physical cash the worker takes home. The other portion diverges to account for tax. Employers are legally required to calculate PAYG tax and withhold it from the gross amount. That withheld portion must be sent directly to the ATO. This must happen before the physical cash envelope is ever handed to the employee. Cash workers often fall into the trap of only knowing their final net weekly cash amount, say $700. If the worker does not know how a gross figure became that $700, it is mathematically impossible for them to verify if they are receiving the correct legal hourly rate. The ATO assesses an individual's tax liability based on their total gross income, not the leftover physical cash they carried out of the building. Thinking exclusively in terms of gross pay ensures the worker can identify if they are being underpaid by their boss, while accurately calculating what they owe the government. Certain industries perpetuate the myth of a designated cash rate or a special international student rate that sits below standard wages. These rates do not exist in Australian law. From July 2026, the national minimum wage for an award-free adult is $26.44 per hour, or $33.05 for casuals. For workers covered by an award, precise minimums are set based on industry, age, and classification. These statutory rates apply whether the employer uses a bank transfer or physical currency. This chart compares a flat $25 cash rate against a standard award. While the flat cash rate stays stagnant, the legal award rate increases for Saturday, Sunday, and public holiday shifts. A flat cash arrangement deliberately bundles these hours together to ignore penalty rates, casual loading, and overtime. A worker cannot contract out of statutory minimum workplace entitlements. A verbal or signed agreement stating, "I agree to work for $18 an hour," is legally void if it falls below the applicable minimum wage. The cash rate is an illusion. Accepting a flat, off-the-books wage guarantees the worker is sacrificing their statutory financial entitlements under the false guise of a casual agreement. Cash payment does not cancel the employer's obligation to pay superannuation. Eligible employees paid in cash remain legally entitled to their super guarantee contributions. Under the payday super rules effective July 2026, these contributions generally need to reach the employee's super fund within 7 business days after payday. Because off-the-books employers frequently print fake payslips, workers must check their actual super fund transaction history to prove the money arrived. This lack of visibility extends to the ATO's MyGov pre-fill system. Pre-fill relies entirely on single-touch payroll data submitted by the employer. When a business pays off-the-books cash, they intentionally create a reporting blind spot. This graphic demonstrates the trap of part cash, part bank arrangements. If an employer officially pays $600 through the bank and hands over $300 in cash, the MyGov income statement will likely only show the $600. The ATO system will mark it as tax-ready, completely omitting the cash component. A worker cannot knowingly submit an inaccurate return just because the ATO prefill was incomplete. If an income statement is missing cash, the worker must use independent records, like printed work rosters, digital text messages, and bank statements, to calculate their true assessable income. Depositing that $300 cash into a personal bank account later does not tax the income twice. Conversely, keeping the cash in a wallet and spending it directly does not remove its taxability. The taxable event is the underlying work performed. Because off-the-books cash bypasses the digital payroll trail, MyGov CleFill is only a starting point. The taxpayer's independent records must become their ultimate source of truth. Accurately declaring off-the-books cash on a tax return introduces a specific mechanical consequence: the potential for an unexpected tax debt. This stacked column chart illustrates a worker with 2 jobs. Job A provides correctly reported payroll income with tax withheld. The worker then adds Job B, off-the-books cash with 0 withholding. Stacking the untaxed cash on top pushes the total annual income higher, but there are no prepaid tax credits attached to that cash to cover the difference. When the final assessment generates a bill, workers often fear they made a mistake by declaring the cash. They did not. The bill simply proves the correct annual tax was never collected by the employer throughout the year. To avoid dealing with withholding and super entirely, some employers exploit the contractor label. They will hire a worker, set their hours, tell them what to do, pay them cash, and call them self-employed. A genuine sole trader operating an independent business with an ABN is entirely responsible for their own tax and super on the cash they receive. But an employer cannot simply label a standard employee a contractor to strip away their workplace protections. Whether a boss skips PAYG withholding or uses a fake contractor label, the mechanism is the same. The employer is deliberately shifting their own legal and financial burden directly onto the worker. Bad employers rely on psychological leverage to keep this system functioning. They frequently target temporary visa holders and international students, threatening them with deportation if they report off-the-books cash or illegal cashback schemes. An employer has absolutely 0 authority to cancel an Australian visa. That jurisdiction belongs exclusively to the Department of Home Affairs. Fair Work clearly states that migrant workers continue to possess workplace protections, regardless of their migration status. These rights apply even in situations where a worker fears they may have breached a condition of their visa. The ATO has explicitly stated in 2026 that it is cracking down on businesses using cash to dodge obligations. They rely heavily on community tip-offs to uncover undeclared income and cash-in-hand arrangements. The entire cash economy model depends on keeping workers isolated. Fear of immigration or taxation authorities is actively weaponized by bad employers to maintain underpayment schemes. Workers in this position must seek independent help. We can test this statutory framework by applying it to 6 rapid-fire scenarios to see how the law treats different cash arrangements. Scenario 1. Amira works at a grocery shop and is paid cash every Friday. She receives a proper payslip, PAYG tax is withheld, her income statement is accurate, and her super is paid. Her situation is perfectly legal. The payment method is simply cash. Scenario 2. Ken works at a restaurant. He is handed $500 cash with no payslip, no tax withheld, and instructions to keep it off his tax return. Ken must ignore his boss, calculate his actual gross income based on his hours, and declare it. Scenario 3. Lena receives a $700 bank transfer and $250 in cash each week. Her ATO income statement only shows the bank transfer. Lena cannot assume the cash is invisible. She must declare the total earnings, including the missing cash portion. Scenario 4. Ravi is an international student told he must accept an $18 cash rate. Visa status does not dictate wages. Ravi is entitled to the standard legal award rate for his classification, plus superannuation. Scenario 5. Omar works in construction for one builder who sets his hours, supplies his equipment, and pays him $250 cash a day while calling him self-employed. Because the practical relationship is employment, Omar is likely a misclassified employee, not a true contractor. Scenario 6. Maria realizes she forgot to declare $4,000 of cash income on her 2025 tax return. Instead of waiting for the ATO to discover it, she can use the ATO's online services to request an amendment and voluntarily disclose the error. Across every scenario, the physical method of payment is legally irrelevant. The underlying employment relationship and the statutory framework dictate the law. When cash arrangements break down, workers often get lost in bureaucratic runaround. You must direct your specific problem to the correct government agency. The Fair Work Ombudsman strictly handles workplace rights. You go to them for issues regarding minimum wages, award classifications, penalty rates, casual loading, unlawful deductions, and missing payslips. The Australian Taxation Office handles the money framework. You go to them for declaring income, PAYG withholding, correcting income statements, amending tax returns, and reporting unpaid superannuation. The Department of Home Affairs strictly manages visa conditions and immigration status. Do not ask the ATO to calculate your minimum wage, and do not ask Fair Work to determine your tax liability. Directing the right question to the right agency is how you successfully navigate the system. If you accept cash for work in Australia, follow this checklist. Record every payment and shift. Demand your statutory payslips. Check your applicable award rate. Verify PAYG withholding. Reconcile your ATO income statement, and confirm your super actually arrived in your fund. Maintaining independent evidence, like using Fair Work's Record My Hours app, is your ultimate defense against off-the-books exploitation. Information in this video was checked on 11 August 2026. This is general tax and workplace information, not personalized financial or legal advice. Physical cash is just paper. Your rights and obligations are written in federal law, and they cannot be handed away in an envelope.